What's up, everyone? Bronson Kaufusi here. Really excited to talk with Jason Harris. He's my real estate partner, and we're going to be talking about how I got into real estate and our first deal and how it all went. So, Jason, really, thanks so much for being here today.
Today we have Bronson Kaufusi, who almost doubled his money in 19 months. Can't wait to share the story with you.
Cool.
Awesome. Bronson Kaufusi, thank you for the invite and setting this up.
Yeah.
I'm excited to do a deep dive of our first deal together.
Yeah.
Called it Odell Lane.
Yeah, maybe I can kind of start like with my path into real estate, kind of.
Okay.
Because a lot of people are always wondering, oh, you're in real estate, but you're an NFL player. And I'm like, yeah, I wasn't initially though. And I think that's something that every NFL player goes through, where they're just playing football. It's all about football. And same thing with tech founders, because I'm in that space as well. Now it's all about my tech startup, But then it's like, okay, well, what about these? What else is there? Like, I have some money now. What should I do with it? And so in my second year, that's when I got introduced to real estate, and I started to just wonder about it, learn about it, read about it. And then when we met, I was like, oh, this is a good opportunity. So for me, I think that's something I always love to share about is you're doing what you love. Keep the main thing, but there's other opportunities out there. You don't want to miss them.
You coming in with all this excitement with things that you were doing in real estate, things that you were learning, I think was just a good time for me to showcase kind of what I had done in my real estate journey. I started, 12 years ago, bought my first fourplex and turned it into 6, 8, 12, 20, and, eventually thousands of units at which we're at today. But started small, started early as well, and the compounding is real. And I think through doing the value-add approach is the best method in that you're in affordable housing, which is a big need in America. Mm-hmm. And beyond that, there's a velocity of money concept where you can put your money to work, get it out, retain the asset, and go repeat and build the portfolio and continue to grow. And so it was just good to get to know you and Hillary, understand what your goals were. Obviously, I was a financial planner in the past. I think that helped too in some of our conversations. But definitely. Yeah, it was awesome.
Yeah, I was so for me, as an NFL player, you get kind of just thrown into the fire from a financial standpoint, and so for me, I was like, man, I need to make sure I have the right people around me, and whether it's financial advisor, real estate. I don't know what it could be, anything. And so I think for me, like when we met, I was most impressed. I mean, I loved what you were doing in real estate, but I was most impressed by, man, Jason's a great guy. He loves this. Like, you're so passionate about it. That like really blew me away. I was like, man, he loves this. Like, wow. And so one thing I think every NFL player and athlete is an expert in is making a team. And because you've done it your whole life, you know well how to make a team. And so for me, I was like, okay, whoever I partner with in real estate, I know they're joining my team. I'm joining their team, and we're going to make a new team. And so I was really excited just from your experience, your willingness to teach me, tell me how things work, because there's a lot of things you just don't understand. But I just loved how when we would sit down and talk about it, I loved how I could just ask anything, even though, I bet you some of the questions weren't the best questions, but, for me.
You had great questions. Honestly, I appreciate you saying that. Real estate has changed my life. I mean, literally changed my life. I grew up, with humble beginnings and didn't have much, and money was always something tight for our family. And so bought a fourplex when I was in college, continued to compound and grow the portfolio, and eventually, put me where I am today. And I'm floored at how quickly the compounding of what wealth when it's working for you can help you grow and get to a different place in life. And so it's not just selling real estate anymore, because it's my story, it's my journey, it's my passion, it's my love. And so you were talking a subject that I absolutely love, I'm passionate about, I've dedicated a lot of my life to it. And I think having the financial planner background, only helped with a lot of the questions that you and Hillary had as far as how can I make my money work for me? I don't plan on always being able to have this strong income. I hope to, but post NFL, I really don't know what that looks like.
You never know when it ends.
Yeah.
You never know when your athlete career
every
ends.
Every year it's not a guarantee necessarily. And so, no, you had great questions. And I think just my background with what I studied and learned, having worked with some affluent families early in my career and kind of learn what the wealthy are doing to protect their money, grow their money, and estate planning and tax shelter strategies only helped me make better decisions for my own real estate, my own investments and portfolio, but then also share it with those people who it was applicable for and appropriate. And so you coming in along my journey and your own journey, we kind of met at a good point where I think I was able to offer and share hopefully some valuable advice that helped you and Hillary make some good decisions. So
yeah, no, definitely. I think you talking about the BRRRR method, the multifamily value add. It just meeting with you, it just made sense to me, because you don't want to over leverage yourself and do things like that, but you don't want to go under. Even though our natural, even when we met, I remember I was very skeptical, but I just didn't want to put too much in, but not too little. But it's like, oh, what do we do? But when you understand the multifamily value add method, where you're going in, you're getting the place, you're adding tons of value through renovations, paint, whatever you're doing, carpets, I don't know, and then you're turning around. It's after a certain amount of time, and it's got all this value. It's hard to lose. So I don't know what are your favorite parts about multifamily?
Well, multifamily specifically, there's just so much you can do to create value. And I thought we'd even give an example of our deal, our first deal together, and kind of what we were able to do on it that helped push value significantly. I always look at it from the mind point of what the tenant wants, what they're willing to pay for, adding a doggy park or giving them some extra storage, covered parking in the winter and summer. What are they willing to pay for? What do they see as value? And then you go about it as, what would it take to create a covered parking area or storage units or doggy park? And what kind of income would the tenants then be willing to pay that would then provide additional income from the property? And that's how I look at the return potential. And you just don't get that in a lot of different investments.
Yeah.
Even this year in 2022, with interest rates on the move,
it's
been a scary time for a lot of people owning all types of assets. Mm-hmm. We've seen a lot of asset classes drop in value. Well, multifamily specifically, we've continued to increase value due to the ability to add additional profit centers to the bottom line. And so storage units, covered parking, like I mentioned, RUBS, which is a utility build-back program, raising rents. Right now, inflation's causing a lot of people. Obviously, it's a talking point that's in the news everywhere.
Yeah.
But we're seeing that market rate rents have drastically increased. And so I'm able to buy a property at $800 an average rent rate and post renovations to the exterior interior. Maybe we're seeing 12, 13, or 1,400 post renovation. And so it's easier to then look at what your return potential is. And multifamily gives you that ability to be flexible, have a level of control over the deal, and make decisions that are necessary as economic activity changes. And so, for you and I think that was what really helped us crush it on this first investment we did together. Is we bought it in a good price point, and we saw opportunities to make it a lot better than what the current owners had been doing.
Yeah.
And so we talked about putting some money to work in renovating the interiors, and we bought it with about $840 a unit rent rate range, I think is what it averaged.
Yeah.
And once we sold it, we were getting closer to $1,350 a month. And so, big $510 increase per unit. it makes a big difference on what a future buyer would be willing to pay for the property because of the interest income. So,
jeez, see, that's so cool. I think that's something that as a NFL player, you don't really know that, and you don't really realize, that's really. It's just an equation. I mean, I love numbers. I graduated in statistics.
That's right.
I love numbers, and so when you're talking these numbers, wow, you increased that by over $500, and now because everyone's rent is higher, it increases the value. That just makes sense.
Well, and you can calculate it even before you put the money to work. How many other investments do you know the return you're going to make?
So true.
Before you actually invest it, you have an idea or you hope it goes well.
Yeah.
But real estate, I mean, on Odell Lane, for example, the storage units, we were able to get $25 a month per tenant. This was one of our smaller deals back in the day when we were doing syndications.
Yeah.
So it was a 10-unit property. But it only cost about $500 per storage area for us to provide a place where the tenants would pay the $25 a month. And so across the 10 units, a $5,000 investment, but we have 10 people willing to pay $25 a month. That's $250 a month, or $3,000 a year. Times it by 12.
Yeah.
So spend $5,000, get $3,000 back annually.
Yeah.
That's a 60% return on investment, and we know it going into it.
Isn't that nice?
it's a reliable rate of return that's pretty predictable. That's really, really good. But on the BRRRR method or value add method, it can be even better than that, because typically we're not holding the property long term for income only.
Yeah.
You can.
Yeah.
And that's the flexibility, again, that we love to have. But for you and I, we want to put our money to work and have it continue to compound and grow.
Yeah.
And so what we looked at it and said is, what would an extra $3,000 a month of annual income that we now can derive from the property, what would a new buyer be willing to pay for that extra $3,000? Well, in Salt Lake, where this property was located, things are trading at below a 5% cap rate. And so let's just use 5% because it's an easier equation. But 5%, if you take $3,000 net operating income divided by cap rate, which we'll say is 5% in Salt Lake, that means $60,000 more is what someone would be willing to pay in additional property value, because $60,000, if you expect to get a 5% rate on your $60,000, that would be $3,000 a year.
Yeah.
And so we didn't look at it and say, okay, let's put in $5,000 so we can get $3,000 of income and make a 60% return.
Yeah.
We looked at it and said, let's put in $5,000 and turn it into $60,000.
Oh, that's so crazy.
A 12x of our money in about, I think it was 18, 19 months that we held the property. And we did that towards the later end of it. And so we're talking about 12xing our money in a very short window of time with some high degree of confidence that it was a reliable return.
Yeah.
And you just can't do that in other asset types. And so that's what I love about multifamilies. There's some predictability as to what type of return you can make, because you can do your analysis and run your numbers ahead of time. And so you and I, when we looked at the property, we saw some exterior improvements we could make.
Yeah,
we
painted it.
Painted it, made it look nice and more modern. Updated something that the tenants could be proud of because it's their home. They want to invite their friends and guests to come over. We did some updates to the common areas and then the interior, and that's what really was able us to push the unrenovated units to about $1,050 a month from the $750, $800 they were at. And then some of the better performing units, we got up to $1,350 to $1,400 after we did a nice interior renovation. And so you start doing the math, our $150,000 of capital improvements that we made, turned into almost $1 million of additional equity that we created in the property. And so after closing costs and some other fees upon selling, that's why we walked away almost having doubled our money in those 19 months of owning the property. So pretty good return.
Yeah, but the craziest thing about it is it was expected. Like we knew going into it. And I think that's one of the things, as for me, a newer real estate investor, blew my mind. Like, is this real? Like, you actually know this before you put in this money? And so
this was your first deal.
Yeah.
Right?
Yeah, it was. And, for me, my eyes were just opened because I felt like as an investor, or someone that kind of just you're given a lump sum of money as an NFL player or tech founder, whoever, you just I'll just put it in the stock market, I'll do this or that, and it's just, and then you realize there's a lot better, there's different asset classes that you can navigate, and you can the numbers don't lie.
Well, and I mean, as a financial advisor, I still invest in the stock market. I max out my retirement accounts. I have money that I put to work there too.
Yeah.
But what level of control do I have over the outcome there?
You don't know going into it.
What you and I knew, going into it.
Yeah.
In fact, I think we delivered on what our expectations were. We didn't expect to do as well as we did. It was even better. And that's part of just being a little bit conservative in the underwriting.
Yeah, true.
Feeling like this is something that we believe we absolutely can hit.
Yeah.
However, here's more of a best case scenario of what's possible. But we don't want to get hung up on expecting that. You know, we need to have where whatever the very reliable outcome is, for it to be good enough for us to decide to make the investment, right? And I think you and I looked at it and said, if more of the, not worst case, but of a average assumption could happen, would we be pleased with how hard our money's working for us? Yeah. And if the answer is yes, then that's when you say, okay, let's do this, and let's go for the best case scenario and still try to make that outcome happen. And I think that's what we were able to kind of see in the Odell Lane property. Yeah,
and I love what you're saying about making your money work for you, because we hear that all the time as NFL players, because we get educated on different financial literacy options and things. They have classes for us, and we always hear that all the time. Make your money work for you. You hear it from older players. Make your money work for you. It's like, what does that actually look like? How do I actually do that? And so, for me, when we were meeting about this deal, I was like, okay, well, this is around 18, 19 month hold. So I'm not going to be touching it, but I'm not going to be touching. I did the math in my head within my portfolio of what amount of money am I not going to touch? And I took that amount and I said, okay, let's invest this. And I remember you're like, oh, we might need a little more. You remember that? And I said, are you sure? And you're like, yes. And I'm like, I was like, well, the numbers don't lie. I had seen them. I, understood about your past experience and, what you were doing. And I was like, let's do it. And then we did it. But for me, it wasn't, I had just understood how this type of deal works, that I knew even though I wasn't going to be touching it, it's growing, because it's you have something tangible and real estate's unique like that.
Right.
Just maybe you could touch on that. Yeah.
Yeah. Fortunately, we had a really good track record, I think, that helped you feel more
true.
comfortable. We talked about a lot of other deals we've done and I've done and what I've been able to do in real estate. And I'm sure, speaking to the other asset classes at the time, I think you were in muni bonds, which earning maybe 3% tax-free. And so maybe 13, 15K a year is how hard your money's working for you. Yeah. Nothing to retire on or, get too excited about yet. Over time that can be perhaps meaningful, but there's other ways to derive just as much income or more while also having growth or equity and appreciation, which is the big bulk of what we had in this particular deal. And so I think that perhaps helped to see the opportunity to really put your money to work in a meaningful way, knowing that the money was still there, even accessible, but kind of illiquid too, so that you can't touch it or won't touch it, so that you can allow it to do its things for us to really turn the property around, stabilize it, and find its highest and best use. Because once you've been able to do that, you've derived all the value and profit center opportunities within that property. It's now time to sell it, maximize your return, and go repeat the process to do it again. And so that's ultimately, I think, what we looked at and said, this is about a 1.5-year type property with the size it was. And we wanted to, there's some really cool tax treatment opportunities too that we didn't look at for this but we're looking at it for our other investments we're doing. And so what was your question again, though, about the liquid? Or
just because I felt like a lot of, people that aren't coming from that background where most of their money is in the stock market where they can pull it out whenever they want, and other investments where you can do that. I think maybe you can touch on how really it is locked up, but it's not, in a sense. You know what I mean?
It's just like when you purchase a house. I think we talked about this before. you have to give a certain amount down and the bank finances the rest unless you're paying cash. Yeah. Either way, you're writing a check or you're sending a wire and that money's put to work somewhere. Yeah. But you don't see it anymore in the bank account. You'll see it on a statement.
Yeah.
However, it's still there as working as equity within the building. And if you want to access that, you can do it in the form of a line of credit, cash out refinance, or just selling the property to get all the money back, right?
Yeah.
And in investment real estate, what I love so much about it is I know that property value is typically derived by what the net operating income is of the property.
Yeah.
Just like any other investments. If you're going to go buy a business, what do the financials look like? Show me the profit and loss. I want to see what the real net income and revenue is from the business for me to get an idea of what kind of multiple I'd be willing to pay for it. Yeah. Well, with real estate, it's the same thing. What type of income is the property producing currently? What could it produce if we were to do some capital improvements like you and I did?
Yeah.
What if we just manage it better? Sometimes you have an out-of-state owner or a distressed seller or someone who's just not maybe maximizing the property's potential, and so the operations and performance is a lot lower than what it could be if you had a better operator, a better manager. And so we come in with a business plan on how we can find the highest and best use to get the property to its best performance.
Yeah.
And so it's through that I trust taking a property from, say, $100,000 a year of net income to $160,000 a year of net income.
Yeah.
You could almost say that's a 60% increase to the property value. And so, if you buy a property for $2 million, increase it by 60%, it should be worth $3.2 million at the same cap rate. And so I think what makes it easier for me is maybe a more sophisticated investor, having done hundreds of transactions in real estate at this point. I know the numbers, and I know that the numbers speak to what the value of the property is. And so even though I don't see our equity and our initial capital that we invested there, I know what's going on well enough in the property that we're increasing and improving the equity and the capital, trusting that the net operating income is increasing in a way that's going to allow us to exit at a much higher price, locking in a really good return and getting our initial capital back. And so
sounds like there's winning everywhere.
It's really difficult. I get that because you see this big lump sum of money come into your account and you get all excited. Yeah. And then you don't want to see all of a sudden so much of it stripped away and you feel like you're living on a lot less, or what do I do now?
Yeah.
And kind of understanding and knowing that real estate has multiple profit centers. There's the cash flow that's liquid that, in our real estate fund and our deal together, we can have quarterly or monthly cash flow distributions.
Yeah.
So then you're seeing a little bit of return while the bigger return through the equity creation's happening.
Yeah.
Principal reduction, which is something you won't see till you sell either.
Yeah.
And then, the forced appreciation, which is the most meaningful part of it, right?
Yeah.
And honestly, there's another one. You and I didn't do it yet for this deal, but plan on doing it, in times to come. But in our real estate fund, for a lot of our investors, the tax shelter is a very meaningful part of the investment and why they love real estate. I mean, passive income is obviously exciting. It's something that you can have as retirement or just something to live off of, making your money work. But the wealthy buy real estate for the tax shelter benefits. And that's when it really changed for me, Bronson, understanding how meaningful real estate can be. And I don't know if you want me to touch on that.
Yeah,
I know on ours.
No, I am curious because that's something you don't really think about, is especially as like a young investor or a young person or a younger individual who has, money now. It's like, oh, you get hit with that first, tax season and you're like, oh my gosh, what happened? And
half of it's gone.
Yeah. But you always hear though, like the wealthier are always, tax sheltering, and they're finding ways so that way they don't get hit as bad. So I would love to hear that and hear how, newer investors, people like me can leverage that.
So this is, again, another one of my favorite topics, right? So I'm writing a book, I'm starting a podcast, right, to teach and talk about some of these things because it's so fascinating and powerful. The Bureau of National Labor Statistics actually shows what the average expenses on the consumer spending survey we spend our money on throughout our life.
Yeah.
And the biggest number one expense is housing.
Whoa.
Now, Bronson, truly it's taxes. They actually can't include that bucket. But if you look at federal taxes, state taxes, property taxes, sales taxes, estate taxes, I mean, there's all kinds of taxes. Truly, it's our number one expense.
Yeah.
And then housing is number two. And so I created my financial plan around how can I reduce these expenses so that I can have more disposable income, keep more of what I make, so that what I keep I can put to work and make work for me.
So smart.
and that's what's helped me, accelerate kind of my wealth strategy and my journey is by not paying as much in tax liability legally, by understanding ways that I could reduce my my tax liability. And so here's some of the ways I learned through others and now myself, and we help our client base do the same. Is real estate has one of the best tax strategies available within the tax code. Yeah. It's literally the king of all tax deductions. Most tax...
Oh, man, everyone's got to listen up now. Everyone listen to this, okay?
Most tax deductions, you have to spend money in order to get the deduction, right? Mm-hmm. You go buy a water heater for your property, and you can expense that because it's a typical expense that you have to have in order to help the tenant have hot water, right? Yeah. So they allow you to write that off. Well, depreciation is phantom. It's not real. Yeah. So you're not really losing any money. But what happens is you don't have to spend any money in order to get the benefit. Yeah. Imagine being able to buy things like an asset, piece of real estate, for example, and then it itself gives you a massive loss. That loss can now be used against all different types of income that you may have on your tax return.
Which is a lot.
Which can be very meaningful. And so I'll give you an example. Maybe we can just use Odell Lane as one of them that we did. And so we decided to use the straight line method. Yeah. And there's two different accounting methods, straight line or accrual, which is the accelerated method where you can take more of it up front. Yeah. Most CPAs, if you don't tell them otherwise, are just going to do the straight line method. Yeah. Where they're going to depreciate the building over 27 and a half years. Now, what does that mean? Well, the building itself, the IRS is saying, goes down in value if you don't take care of it, because it's going to lose its use. Okay. Yeah. So if you don't replace the flooring and the countertops, appliances, can you actually rent it out over enough time? If not taken care of, it will lose its actual usage of being an investment. And so they allow you to deduct that because they know it. You're going to have to replace the carpet, the countertops, and all of that. Now, we know that properties actually go up in value through appreciation typically. However, there's still this great loss called depreciation. And so again, over 27 and a half years. So our purchase, we were able to get maybe through the straight line method. You take it over 27 and a half years. Let's just call it $20,000 a year of a phantom loss through depreciation we could use. Yeah. And most of the time that's limited to your passive income on your tax return. So any private equity investment or real estate through cash flow, that's considered passive income. And so the depreciation can offset that. Normally it'd be taxable, but now we don't have to pay taxes on it. Well, those who do it right, Bronson, understand there's a better way even to take those losses. And so that's something that we do. Is called a cost segregation study. Got one of these reports actually with me. Oh, sweet. Where let's look at the real loss. I mean, do you think the building actually goes down in value equally over time? No. I mean, carpet's not going to last as long as the brick on the exterior, right? Everything has its own lifespan. And so what we do is we have an engineer or CPA go and actually do a study. They itemize the property and say, carpet and flooring, these are 5-year life items. And this is going to last 7, this is 15, and the exterior is 27 and a half, right? And so it shortens that lifespan that the building is actually going to have
so smart
usage, right? And so you can take more depreciation sooner. Well, in 2017 and 2018, through the Tax Cut and Jobs Act, the rules on how you could take that depreciation got even better. And they're still applicable today, and they phase out into year 2026. But right now, you can take 100% depreciation loss in the first year on any item that's a 20-year life item or less on these cost segregation studies. And so that equates to about 30 to 35% of the purchase price of a building. Yeah. And so, you and I's purchase price was $1.5 million on our deal, right? And so that's close to a $525,000 first-year write-off. And so let me ask you this. Do you want a $20,000 write-off, or do you want a $525,000 write-off?
Definitely $525,000.
Right? Exactly. That's very, very meaningful, especially if you're a high-income earner.
Yeah.
If you're high net worth, high-income earner, you're paying taxes at one of the highest tax rates, 37%, about to go up to 39.6.
Yes.
If you pay state taxes as well, you're talking about over 40 cents on the dollar. What would a $500,000 loss look like for someone in a 40% tax rate or more? That's over $200,000 of tax savings.
Whoa.
That money otherwise would have gone to the IRS, but now you get to keep and, in my opinion, put back to work and more assets.
Yeah, just let it keep growing.
Exactly.
Get more units, do this. And
Well,
that's what you did.
That's what I did.
That's what you did.
So I haven't paid taxes legally in 5 or 6 years now because I take all of this disposable income,
Wow.
I put it back to work, buying more real estate. And it's not just only real estate. I have some nice cash flow that I get from my real estate. So guess what I feed my IRAs and my retirement accounts with?
Yeah.
I take some of that cash flow I don't need.
Yeah.
I still have active income that I can live on.
Yeah.
I don't need this discretionary passive income that I'm
Yeah.
making. And so they work together. So I've got, my stock portfolio, I've got my retirement accounts,
Yeah.
I've got real estate, I have other assets. But the point is, it doesn't have to be either. It doesn't have to be either or. Is stock market, is crypto, is real estate, what's best? They actually can all be great together. In fact, I think everyone should diversify.
Yeah, I agree with that.
But real estate's been more meaningful for me, and it's been where I start and have the majority of my money because there's great tax shelter benefits it provides me.
Yes.
And then I can take those tax shelter losses, offset all the income that I'm making, not give away 40% of everything I make, take that money and then diversify into other assets, right? So it's a great strategy.
This is... Yeah, I love it because I'm thinking of someone, like myself, like you. You said you didn't grow up with, in high earning household.
$30,000, $35,000 a year.
Yeah, and I think a lot of people that are listening are like that. But now you've learned this strategy that is so key, and especially for those who are high income earners. So when you're as a NFL guy or a tech founder or someone just has a lot of a company that's been growing for a long time, a lot of people don't know about this.
Yeah, it's funny. I keep thinking, why do we not teach this in the school system? Where would we learn about this, and why is it not taught? But really, it comes down to, I realize, take my parents, for example. Mm-hmm. What if they had received a $525,000 a year, or one-time loss, versus someone else making $1 million a year, right?
Yeah.
They're making $30,000 a year, 30, 35. They already have some other write-offs and deductions, so their total taxable income's $10K or less, right?
Yeah.
And so a $525,000 loss,
you're gonna max it
on $10,000 of taxable income, it's going to take 52 and a half years for them to even use it, and it'd be used at the lowest tax rate because we're in a progressive tax rate system, right? The more money you make, it's taxed marginally at a higher amount. Yeah. And so for someone making $10,000 to $30,000 of taxable income as their tax problem versus someone who's making $1 million a year or more, who's in a much higher tax rate, they're the types that'll actually need and utilize that type of benefit. And so really it's applicable and appropriate for all, but really it's those who make a lot of money that really would have the need, and why only someone maybe in that category would come to find out about it through their tax advisor or attorney and whomever it may be that's giving them the advice, right?
Well, you just described an NFL athlete, professional athlete, tech founder, someone who's about to sell a business. These individuals can do that. But then, like you said, they are able to use this, extra cash coming in for other things. I think that's a big deal because, you can put it into other investments. You can put it into charities. You can put it into so much and do so much more with it. I think that's huge.
It really is exciting, Bronson. I mean, it's been meaningful for my family, but I've seen it with our investors too that we work with, and helping them, working with their advisors and their team to help set this up. And so I want to be clear, this isn't something everyone can do.
Yes.
Everyone could do it. It's just not everyone does it. And so it's available to all, but there's certain requirements to make it where these losses can be used to offset all income. And so we talk about that, how involved and active are you in the real estate, or are you passive? And what other things are you doing? Could we set things up and design it in a way where you could use more of these losses today so that those losses can help save taxes on what you would have had to give to the IRS and put to work now? So there's the time value of money concept where you can compound that wealth now instead of waiting to use the benefit over 27 and a half years on the straight line depreciation method, right? And so we go through that with our investor base to discuss when would it be appropriate and what's most meaningful for you. How could we help you utilize these losses? Because that's something completely separate of the actual returns we're generating from the real estate deal, right?
Yeah.
This is just a fourth profit center opportunity.
That's what I was just thinking. It's a profit center you just made.
And it can be a meaningful one, a very meaningful one for certain people. And so we've worked with business owners who've exited and sold their company for tens of millions and even hundreds of millions. We've represented a few like that. And so you're talking about a significant capital gains tax, right? And so we're looking and finding ways to take some of that money, put it to work in real estate in ways that they can use the real estate as a write-off, a massive tax shelter to minimize their capital gains burden. And the best thing, Bronson, is a lot of these people want to buy passive real estate anyways. And
literally everyone wants to.
We're not talking them into a product or an asset that they don't already want, right?
Yeah.
Most 90% or more of millionaires in America own real estate, and it's been the primary vehicle that's helped them get there. And so it's not a new concept. I mean, real estate should be part of one's portfolio, making sure you're buying maybe the right kind of real estate. But my point is the tax shelter benefits can be very significant for a high-income earner, for a high-net-worth person, someone selling a company. I mean, NFL guys and other professional athletes that we work with. And so I just think that's really exciting when they start seeing not only can real estate click. It's not just a good return. It's not just passive income. This can also be a meaningful strategy to help us minimize our tax burden. And that's when it just gets really exciting. Real estate is awesome for all of the different, components that it can help bring into a wealth strategy. Yeah.
Oh, it's so true. It's so true. And I love how, willing and open that you are to share this. Because I feel like as a NFL athlete, it's you want access to this stuff. Like you want to be in this space. You want to know these things. But it's just finding how do you trust someone like that? And I think that's the biggest hurdle. But I love how you're willing to share this with everyone.
Oh, I appreciate that. And a lot of guys are doing real estate, right, in the league. Yeah. However, I would like to think we're generating some pretty good returns. It's hard to imagine people competing with the type of return that we're making. And I think if you look at the risk-reward dynamic, we're not even doing highly aggressive strategies. We're just looking for distressed property that's in the affordable housing market, so that if a recession or a crash were to happen, we're already catering to the lower end of the market rent range, right? Yeah. There's always going to be people who have a need for housing there. We're not on the Class A highest rent
positioned
range.
Perfectly.
So it is. It's a very recession-proof type asset. If you look at 2008, 2009, the last crash, multifamily housing was one of the best performing asset classes. In fact, a lot more people couldn't purchase a home, had to turn to renting, and so the renter pool actually increased. And so a lot of our properties performed well during that time. Yeah. And so it's just a great asset to be in. There's great returns. There's less risk per the return that you can generate. Yeah. And, we've done a really good job of generating, really significant returns. I think you and I still, I don't know if you want to share kind of what your experience was on it, but it's been really good. Yeah.
My experience as far as the return goes, I knew it was going to be good because I knew the numbers, I knew the value add, I knew what we were doing. And when we turned around and sold it, I believe it was a 94%, right? I think
so.
Right? Yeah.
94% ROI.
Yeah, ROI. So that's incredible. All right? Like that really is incredible because you're going from whatever you're investing in, like me, I was getting 3%. Right? Compared to 94%, that's the big difference. And so
you would have been at 4.5%, 5%, maybe compared to the 94%. without any tax benefits, that the real estate provided, meaningful impact to now, you're still young, have tons of time on your side for compounding, but having almost double of what you started with versus
incredible
4 or 5% more makes a big difference now moving forward as far as what you can do with that money. And so now, you're looking at other ways to continue to diversify real estate. You have several other investments too that you're doing, and I think it's great.
Yeah, no, I know, I appreciate it, and because I think, when you go to invest in something, I feel like one of the questions is, oh, does this person want me only to invest in this? But I think your background is so unique because you're a financial advisor as well. So you come into it with a different view, or you want people to be diversified. Now, real estate is great, and you can put in as much as you want, right? Which is awesome. But I really love that. And I think, moving forward, it's like, wow, I got to keep doing this. Because after that first win and you see how incredible it is, it's, okay, like what's next? So maybe you can talk about what you're doing, today, right now, and moving forward.
Personally or with our company?
With your company, yeah.
Okay.
Yeah.
So, I'm the founder of Harris Investment Group. So, we raise capital from investors, mostly for real estate. Same type of real estate that you and I bought.
Yeah.
It's the value add, mostly 100, 300 unit type size. So you and I's deal was much smaller than what we're typically doing now. And finding the highest and best use, creating a business plan. We're asset managers. And so last year, I think we closed on over $300 million in real estate portfolio value, raised about $80 million from investors. And so that's what we do now and are continue to growing. We've just hired a few new people. I think you met today, and so it's exciting. We do it a lot in gas stations as well. I mean, our primary asset class is the multifamily, and I think it always will be. It's what we truly believe in. But there's some massive tax benefits in oil and gas. Yeah. And so gas stations with the triple net lease benefit has become more meaningful for some of our investor base. And so, raising money for different real estate deals to derive a return and make it a passive approach for our investors as an asset manager is what we're currently doing. Based on my background and some of our other team members who come from Wall Street and private equity, we have a venture fund that we do some private equity investments and some venture, and that's something I do with some of my other monies as well. And I'm loving it, Bronson. It's just so fun. I meet a lot of great people like yourself, and just love it. I mean, it's not work. This is just me doing what I love to do, and getting to meet great people. Well,
you're in such a great space, and I think it's so important for people, especially with investing, to know if you're going to invest with someone. It's so important to know where they came from. Where did they start? That's what I want to know.
Amarillo, Texas.
Yeah, Amarillo, Texas. Yeah, there you go. When you started with nothing.
No, started with nothing.
Nothing. And then you grew it all the way to where you're at now. I can't imagine the amount of lessons you've learned and experiences you've had to the point where now you're, instead of going from a duplex to a quad, however that started, right? You're now going on 100 units, 300 units, deals. That's just, it's incredible. And
closed on a $61 million deal Q4 last year. So it's a completely different game. But I totally remember
you grew with it,
right? And I appreciate you sharing that, because there's so many lessons to learn when you don't have money on how to still invest in real estate.
Yeah, you can't make as many mistakes. You're going to make mistakes, but you don't want to make as many.
You know what's funny about that, Bronson? I actually believe that when you don't have anything to lose, it's easier to be aggressive. I was very aggressive, wild west, country boy, right? And it's like, what do I have to lose? I literally have nothing. Who cares if it doesn't work out? I'm young. I can start over. And fortunately, I had some luck on my side, or I was just good enough at what I was doing that didn't happen. But I put everything but $6 in the first fourplex I purchased, right?
No way.
No money in the bank but $6.
Man, you sound like The Rock. $7 in your pocket.
That's right. It pretty much was. And he had a lot more opportunity, I think, than I did. So, I mean, I just went all in. Really, I believed in it enough. I trusted the numbers, and had all of my down payment money back within 2 months.
Wow.
With the different, I was able to get my security deposits when I purchased an investment property. I got prorated rents. The first month of the mortgage I didn't have to pay for because it's all rolled up.
Yeah.
And so I got rent income from the property, but without paying a mortgage. And so all of a sudden I got all my money back. It's like 2 months later, I owned the fourplex.
What'd you think?
And I have all my original. Oh, I was blown away. It's just amazing.
Yeah.
And so that kind of set the velocity of me being able to purchase the next property and continue to repeat that. And so this first one was an owner-occupied deal. So I moved in, but when I moved out, I rented it out for a lot higher than what it was before I moved in. And so all of a sudden I started learning some of these concepts and principles. But the point is, when you don't have a lot, you have to do everything you possibly can to maximize the return. And so I was analyzing different financing products like conventional loans, portfolio loans, owner-occupied loans.
Yes.
I learned more about...
That was huge for me in our deal.
Yeah.
Because I remember you were saying, what kind of blew me away was, I was thinking, man, I have to have all this money up front. But it was like, you had so many different ways to get the property. And I know you're doing it now even, but you had learned so many different ways. And so there's options. There's always options.
There's so much to be learned in the struggle, right?
Yeah,
that's
true,
where we
true.
really dig deep and have to find out, like, what am I made of? Like, there were a lot of times it was scary, it was hard. I mean, lots of late nights, and I learned a lot through that journey and through that process, I think, to better equip me today. And the way I do business now versus the way I did business then is a lot different because I have something to lose now, and I have to have a different mindset. I took on a lot of personal guarantee and recourse type debt in the early years.
Yeah.
That's what a traditional loan is.
Yeah.
Where now most everything we do is non-recourse.
Non-recourse, yeah.
So there's no personal guarantee. We work with a lot of high net worth individuals. We can't put their own other assets at risk in a deal that we are performing for them. And so there's all kinds of things that you learn for liability protection, asset protection, and again, tax shelter is a big key piece of what we do of delivering some nice depreciation loss benefits. And so what I did then versus what I do now is different. However, I would say that there's so much I learned in that journey that's made us, I think, more sophisticated investor of understanding all these little things that in aggregate add up to be a very meaningful difference on how we can outperform or generate a much better return than maybe just the less experienced or less sophisticated investor would.
Yeah. See, I love that. Just because even though you're doing these massive deals, you're still taking the skills that you learned from when you first started, and they're still helping you.
Never would you have been able to tell me, Bronson, that was a blessing then, because those were hard times, genuinely hard times. But man, I look back at it now, what a blessing it was to go through that, because that's where all the lessons were. And I learned so much through that. And, you know, it's interesting. I meet people all the time who have just so much more in way of degrees or whatever it may be. And experience can teach you so much, right?
Oh my
and
gosh.
so I find it funny. Like I've meet people on Wall Street and private equity all the time, and we talk deals and we talk numbers and we talk investments, and I just find it interesting, you know, how much more I know than they do around real estate specifically. And I'm just blown away because they're making major decisions for Blackstone or some of these the biggest groups that take in billions of dollars. And I just think, wow. I mean, I didn't even go to school for this. I was an econ major, so I understand some concepts behind it. But real estate specifically, I've just loved it. I mean, it's changed my life, and it's changed the lives of people I work with, and just such a fun. There's just so much to do within it. There's so many ways to buy it, and I guess there's wrong ways, but there's a lot of good ways. I just think that the way we do it offers the best risk reward to generate great returns in a more recession-proof manner with great tax benefits so that people can keep more of what they work hard for and put that money to work and grow and make something out of it. Yeah,
I think that's so big. Like that passive, to know that it's passive and that it can benefit you that much, it's like, wow, I should have been doing this earlier, you know?
And you were young and you started early.
Definitely. I think that's something that I think people that are listening to this are probably blown away with is, wow, there's all this out there for me. Like I can get in there. And like you said, it can help so many, guys that like NFL players, people who come into money all of a sudden, and it's like, what do I do with it? Oh,
it's scary for some of them, right? Because it's like, I've never seen so much money. I don't know enough about money, so it makes you a little timid to even like make a decision because
that's true. I felt that way.
Yeah.
I felt that way.
Yeah.
I was like, this is a lot of money.
and you don't want to mess up.
You don't want to mess up because it's literally blood, sweat, and tear money. That's what I call it. It's blood, sweat, and tear money. But then when once you learn and understand something, that's so important. Is I felt so confident in it. I just knew. Like I just understood it, and I really wasn't worried. I was like, this makes total sense to me.
Fortunately, you and I had a chance to meet a few times, right? And you'd come back with some questions, and I think it helped, understanding my background too, is what I knew as a financial planner, but it does require a good amount of trust because this is important money that you've never seen before, and you want to do right by it, and it's hard to know who to trust that money with. And so I think I understand that, which is why I
kind of felt like we were in the same boat. I felt like talking to you, I was like, Jason is me. Like, I'm Jason. Like, he knows like what I've done to get to where I'm at, and I felt like I was you, so we both understood each other. That was a big thing for me, I would say. At
the end of the day, doing the right thing by the people we work with is what matters. I mean, just taking a step back, I mean, I love making money work for myself. I love money working for others, right? And I'm pretty good at it. So, I love doing that. But
one of the best.
Not what I want. I don't want that to define who I am, right?
Yeah.
I'm a father. I'm a husband. I want to be proud of who I am and the person I see in the mirror, and just going every day and doing the right thing and doing the best you can for everybody. I mean, we've grown to the size that we are just from referrals. You can't really find us marketing, and I haven't needed to because we've done really well with the people we work with, and I know that that's going to continue to increase. In fact, I'm starting a podcast here soon, I was just telling you about, and so we are going to start going down that road. But again, I think you do the right thing, you do what you say, and hopefully over-deliver what you say you're going to do, and people start talking, and that's how it's grown organically, because it wasn't ever my goal to grow Harris Investment Group and to start a business. It was really that I was just a really good investor that grew to a big enough size that people took note and wanted to join me in that journey I was on, and started, little by little having investors work with me and get to a point where I just couldn't take on the workload, and so had to hire people. And here we are now at Harris Investment Group, raising hundreds of millions of dollars and so it's just come from an early point, but this wasn't necessarily the goal. It just was a byproduct of me being a really, I'd like to think, astute investor that worked hard to put my money to work, and through generating really good returns, others have wanted to join in, and I hope that's been your experience. I think it has.
Definitely.
I look for many more deals that we get to do together. So love what we're doing.
No, I'm looking forward to it. I think I see it all the time when you have someone that's doing a great, something great, they're passionate about it. It's hard not to jump on the train. You know what I mean? It's going right by you, and you're like, they're great people. They're doing great work. Okay, let's do it. Like, I want to go with that. Jump on with those people.
Yeah, and for me, like, I love that there's people who've just blindly invested several times. Yeah. But I love teaching it too, right?
Yeah, like, you're a great teacher at it. Yeah,
I don't want you to blindly follow me. Let's talk about it. Let's make sure you understand.
Yeah, right? Is it right for you? That was one thing that was really unique, I think, when we met, is we were talking about, is this right for me right now in my situation? Because I told you my situation and, what I wanted to do, and in the future, and my family situation, my NFL career, all of that. And is it going to fit me? Because I know if it didn't fit me, you would say no.
Yeah.
And I know you guys have said no to people. Right. Said this isn't a good fit for you. Mm-hmm. But I think that speaks a lot to, the people that you are, and, the people that are on the team.
I appreciate that. I mean, I don't really need to be doing this anymore, right?
Yeah, you don't.
You're going to be successful, Bronson, without me, with or without me, right? I'm going to be successful with or without you too. But together, I think it's better, right? And
you help way more people.
I believe that. It's what I'm passionate about. I don't need to work with people. I'm doing just fine.
Yeah.
But I want to. And I want to help teach and help other people understand what's possible, because not that this is the typical group that you're working with, but just Americans are so far behind when it comes to preparing for retirement, right?
Oh my gosh, yes.
And have so little, and geez, making good money in America now is just so easy to me. But I wouldn't have felt that way 15 years ago, right? I remember the struggle, but now I look at it and say, anyone can do this. Anyone can have a great life and a great retirement. Mm-hmm. They just lack financial intelligence or knowledge. And that's something I've acquired, and it's something I've learned. It's something I can share and help people do more with their money. And so, anyways, I hope that's what we're doing for you, Bronson.
Definitely.
I think it is, and it's exciting because you are still diversifying, you're still growing, but you see how meaningful real estate can be as a part of your wealth strategy. Yeah. And how to protect more of your money from giving so much of it away to the IRS. And I just think it's fun to see these changes in all of our investors. Anyhow, I won't go into a bunch of examples, but it's fun to see it make a material impact on people's lives.
Geez, that's great. Man, well, thanks so much.
Yeah, thank you for having me. If people want to hear more about your story or hear more questions, how can they reach you? How do they get a hold of you?
Oh, man. Definitely social media, I would say. Go to Instagram, follow me, Kaufusi90, and then just DM me, direct message me. And then as well on LinkedIn, I'm very active there. I love talking about real estate. So add me and message me. And then you can also email me at bronsonkaufusi90@gmail.com. Well, that was the first deal of many, I feel like. And there's so many deals in the future. So if you want to partner up with Jason and the Harris Investment Group, definitely reach out to them and they'll reach back to you. You can do this by emailing them at podcasts@harrisinvestmentgroup.com.